and welcome to the very first episode of Liquor.CEO TV. I'm Charles Vaughn, Liquor CEO. For those of you who haven't watched the other videos yet, I'm a seasoned tax and finance executive with over 20 years experience, most of which has been in the liquor industry. The purpose of this channel is to help you guys navigate how to start your own liquor business, liquor brand, and such. And today's first episode, we're going to talk about entities and actually what is it to start a business and why you'd want to start a business. A little housekeeping first. I hope you like this video. I hope you watch this one and any of the other ones that are on the channel as of the date you watch this. And if there are any suggestions you have in the links and comments below, please feel free to let me know. Liquor.CEO@gmail.com is a direct line to me. And our firm is 40-80spirits.com. There's a chat feature there as well as a contact us form there. You can get in touch with me, let me know any thoughts or suggestions, or if you have any questions about any of the content, or if you have some suggestions about any content you'd like to see. So to start things off, make sure you like the video, subscribe to the channel if you find it valuable in terms of content, and make sure you click the little bell for alerts so that you're notified when new content's uploaded. So why would somebody want to start a business? You have a great idea, and for us we'll talk about spirits, but if you have a great idea for a new brand, you're going to want to professionally and thoroughly set yourself up so that you can build this brand. You have a lot of options along the way, so we're going to cover these at 50,000 feet. And disclaimer, we'll talk about tax and we will talk about legal things to a certain extent, but this is not meant to be official legal or tax advice. You are encouraged to secure thorough tax and legal advice because a lot of the nuances of these variables are going to be dictated by your own specific facts and circumstances. And also, we probably will not talk too much about the state implications. And some from state to state, tax laws and legal liability laws may vary slightly. So in terms of getting the fine tuning of the information you're going to want with regards to tax and legal, I would definitely encourage you to seek local counsel or advice in your home city or state. Okay, so first things first, let's talk about 4 different types of entities that you're going to have to choose from. Sole proprietors, partnerships, corporations, and LLCs, or known as limited liability companies. Those are the 4 basic types of entities that you could choose from. There are others, don't get me wrong, but for purposes of this conversation, in my experience, these are the ones that are the most relevant towards starting a brand. There are 2 types of issues when deciding what type of entity you want to choose. You're going to want to understand your legal liability implications and your tax liability implications. By legal liability, what I mean is who is ultimately going to be responsible for the debts, liabilities that the company would incur. And for tax liabilities, assuming that you have profits, how is that tax collected or levied? What entity, what person, or what body is going to be responsible, liable for that tax? So what let's do is let's break each entity down and discuss them from a legal liability and a tax liability point of view. The sole proprietorship. The sole proprietorship is real simple. It's you by yourself without really forming any type of legal separate entity. You are the entity. Your social security number is used. You can get a tax ID number from the IRS. However, from a tax perspective, you are responsible for the taxes. And from a legal liability perspective, you personally will be responsible for the debts of that company. So that's called a sole proprietorship, where you are responsible personally for both the legal liabilities of the company and the tax liabilities of the company. And just to take it a step further, that will be complied with on your tax returns under Schedule C. So that will be your tax income statement, and your taxes calculated from there. Let's say, for example, 2 folks want to get together and do something as informally as possible, but yet official. That will be a partnership. So a partnership would be basically 2 individuals getting together and deciding to go ahead and start a business. You would execute a partnership agreement between you 2. You could get a tax ID number, much the same. You will file a 1065 form, which is a partnership return. And in that partnership return, based upon if it's 50-50, 60-40, or whatever the split is between you and your partner, you will get a statement called a K-1 statement, which is derived from that 1065 tax form, which tells you how much of that money you have to, or profits, you have to include in your personal 1040 tax return. So from a tax perspective, you are liable for the taxes, your share, personally. And from a legal perspective, you are both legally liable personally for the debts of the company equal to your share of the partnership agreement. The corporation and the limited liability company are what they call veiled entities, which means there is a distinct line in the sand between you and the entity. These are separate legal entities that are created for the purposes of isolating out liabilities, whether they be legal or tax. So the corporation and the limited liability company are both entities that you will form with your Secretary of State in your respective state. For the corporation, you will file articles of incorporation, in which they will file them, docket them, and you will receive a certificate of incorporation. For a limited liability company, you will file articles of formation, of which a certificate of formation will be issued recognizing the limited liability company. From there, for each entity, you will be required to obtain a tax ID number for each entity. And depending upon certain variables in there, we will talk about that in a moment, you will handle the tax side. From a legal liability side, for the debts of the company, this is where it gets a little different from the sole proprietorship and the partnerships. For the debts of the company, you are not personally held liable for the debts of the company. The company in and of itself is responsible for the debts. So your personal assets are shielded from liabilities, judgments, and attachments. If somebody sues your company, that they're stuck there. Again, this is in theory. And the same thing with the LLC. The debts typically, the liability stops there. So that's one of the nice things about the separate entity status of a corporation or an LLC is that your personal assets are protected. So there is a tax shelter or an asset protection, I should say, an asset protection element towards corporations and LLCs. From a tax perspective, it gets a little different. Let's talk about the corporations for the most part. A lot of you have probably heard these things, well, I'm an S-corporation. Well, that's a different type of corporation. It's not. An S-corporation is actually a tax status of a corporation. So let me make this clear. Corporations are corporations for legal liability purposes. They're formed the exact same way. You file articles of incorporation with your state. You receive a certificate of incorporation from the Secretary of State. That's it. If you choose to make a subchapter S, which is known as a small business corporation, that's a tax election. You file the necessary form with the IRS, and if accepted, you will be granted subchapter S, small business corporation status, in which case you are now known as an S corporation. The reason you're known as an S corporation is because that's actually what it stands for, small business corporation, but the tax form you file for a subchapter S small business corporation is 1120-S. For a regular corporation, it would just be a form 1120. Now, what are the differences? An 1120, a regular C corporation, regular corporation, files its own taxes. It pays its own taxes. The tax is calculated on its form, and that's it. That's the end of story. Company operates, has revenues, has expenses, creates taxable income, calculate the profit, send the check in, we're good to go. A subchapter S, small business corporation, is similar in regards in that it operates, on its own. It goes out and has revenue, and it goes out and it has expenses, and it calculates its taxable income. From there, it gets a little different. The 1120-S small business subchapter S corporation does not pay taxes. That particular tax form actually generates K-1 statements similar to the partnership that allocate out the profits or the losses of the corporation based upon percentages of ownership. So if you are 50-50 with a partner, but you've chosen to incorporate and operate as an S corporation, you will each get a K-1 for 50% of the profits, taxable profits of the company. That will actually get reported on Schedule E of your personal return, which is a statement for pass-through, passive activity, or flow-through income. So that's where that will come into play. And you will pay your personal income tax rates on that. On the corporation side, if you file the 1120 and let the corporation pay its own taxes, you will pay the corporate tax rates as prescribed in the code for corporations. So what's the difference? Why would you do that? Well, again, I started this conversation off by you may each have unique facts and circumstances that are special to you that you're going to want to dissect to determine what's the best way of forming, whether you want to make that corporation at S status or not. You're going to want to look at that. So those are some of the types of things. Take into consideration your own facts and circumstances. I personally like the S corporation. It's kind of nice for some flexibility in certain things, but you will pay personal income taxes on the profits because they flow through to you personally. So you guys can discuss that with your tax and legal advice local to figure that piece out. The limited liability company is kind of like a really, really flexible type of entity. Much like the corporation, it is a separate entity legally, so there is that line in the sand between personally being held responsible for the debts versus the entity being as a standalone entity. So there's that protection, which is good. The LLC is unique in that anyone can get that protection. So if you're a sole proprietor and you take the steps to file articles of formation to become an LLC, now you have that protection from the liabilities of the company, but you're still in the same tax boat because the profits are going to be reported on Schedule C. Those are what they call disregarded entities, in that you're a single member LLC, you're owned by an individual. Technically, owners of LLCs are not called shareholders, they're called members. I don't know if I mentioned that before, but if you own a corporation, you are actually a shareholder and you may be a director. But as an LLC, you are a member if you own it, and if you are operating it, you become a manager. So you can be member-owned, manager-owned, member-run, or manager-run LLCs. However, that's a little bit more minutia than we need to worry about. We're talking about macro things here with tax and legal liabilities. So if you're a sole proprietor and you get together, you can have that protection so your personal assets are protected from the liabilities of the company. And you file the income on your Schedule C just the same as you would a sole proprietorship. You just have the benefit of the protection. If two people get together and form an LLC, it can still form the LLC. The entity itself can still be responsible for itself on its own in terms of its liabilities, legal liabilities. But you will also file a 1065 partnership return as an LLC. Since there's two of you, you're required to do that. And each one of you then are also going to get a K1 just the same, and you'll put that on your tax return, and you're good to go there. As an LLC, you have the option of being taxed as a corporation if you choose. So even though you may be a single member LLC, you can file, I think it's an 8832, it's an entity classification form where you can choose to not be taxed as an individual. You can actually choose to be taxed as an association, taxable as a corporation. So if those rates in that scenario fits for you, that's how you could make that election. Otherwise, you'll revert back to either a sole proprietorship or a partnership. Now, if you choose to be taxed as a corporation, as an LLC, you can also from there make the subchapter S election. So your LLC can be taxed as a corporation and furthermore elect to be taxed as a small business tax corporation. So you can be an LLC and go through the whole thing with the S return and everything. Again, the further down the road we get with that, I think we need to be clear that, well, why take the steps of going to form an LLC, to turn around and be taxed as a corporation, to turn around and make the S election to be taxed as an S-corp? Why not just be an S-corporation from the start? Good question. It may be valid. Again, it depends on your personal circumstances. The main reason I like LLCs, and my personal structures are all LLCs, holding companies, subsidiaries, everything, it's because of the flexibility. The LLCs are really cool in comparison to a corporation, in that let's take a partnership where, let's say two gentlemen that want to get together and start a business. As a corporation, they're going to be equal shareholders, 50-50, versus the two guys doing it as an LLC, 50-50. Let's talk about the differences here. In a corporation, whether it's taxes and S-corporation or not, if you and I start a business and we're 50-50, we share 50-50 in the profits, losses, voting rights, everything. Not saying that's carte blanche, the template rule, but that tends to be the rule how it would operate. And so we share in authority, in profit allocation, loss allocation, distribution rights. We share in operational management control, everything. In an LLC, we can actually carve out slight nuances. Let's take our example of you and I in partnership together. Let's say you have all the money and I have all or you have a majority of the money and I have a majority of the industry experience. You may want something where it says, well, hey, you have all the money, you're going to want to protect that piece of it. I have all the experience, so you're going to want to let me drive the ship in terms of operations. In an LLC, you can create your operating agreement in such a way that allows me to have operational control of the day-to-day goings, while the other side of the coin is your financial interest is carved out in a unique way. So we could be 50-50-ish, so to speak, for certain things, but we could be 80-20 in regards to other things. So it allows you to actually pick and choose each particular percentage that you want to do things within each bucket in terms of profit allocations, distribution rights, operational control, who makes the decisions, etc., etc. So it's really a cool and flexible tool to use when bringing on partners based upon what that partner brings to the table for you. So, as you can see, there are a lot of different variances between the taxable side of things, between the sole proprietorship and the partnership versus the corporations and the LLCs. And there's a legal liability side that's very different between the sole proprietorships and partnerships as they compare to the corporations and the limited liability companies. The way to think of it is corporations and LLCs, they are separate entities. They stand alone in terms of legal liabilities. If you're going to get sued, they're just going to sue them. Your personal assets, your home and car, not really subject to that judgment pool. Another thing I want to leave you with is the flexibility of LLCs. I like flexibility. It gives you options. You can always convert later on in life, but the LLCs are really cool in terms of adapting, bringing on investors, selling, changing missions, creating subsidiaries. Whatever you want to do, the LLC is flexible enough to really kind of help you along the way, which is why I like them. Taxable wise, again, you're going to have to get back to your specific partner or send me a note and I'll try to answer your questions as much as I can. But there are unique situations versus if you have another job, if you don't, which could impact the tax game plan for you. But in general, I recommend at least some form of corporation or LLC. And you know, it's either going to be an LLC or an S-corporation for you guys, corporation with the S election. I probably tend to shy away from sole proprietorships and partnerships. You can do the exact same thing as an LLC or some type of corporation or S-corporation if you just have the proper documentation in place to really kind of do that, because you want that protection of your personal assets, everything you've worked hard for along the way, to not be really subject to any type of judgments or liabilities if you are sued or anything like that. So I hope this little bit of intro into entities has been helpful. If not, let me know. If it has, let me know. Again, look for me on Instagram, Liquor.CEO. If you have if you have an interest in starting your own liquor brand, 40-80spirits.com is the place to be. You can chat or contact with us there. And I look forward to hearing from you. Don't forget to smash that like button, thumbs up button, subscribe, and alerts. Look forward to talking to you guys again soon. Have a great day. Cheers and bottoms up.